we can review the AMD signal. Okay, so as I discussed earlier, and can everybody hear me okay? Okay, great. So as I discussed earlier, a diagonal is really the combination of two different spreads. Okay, it's part calendar. Okay, it's part calendar because we're using two different expirations. And it is part vertical because we're using two different strikes. Okay, so first off, does everybody understand that concept before we go into any of the risk, reward, anything? Okay, and I will put this up on a whiteboard. Okay. We bought the June 28th, July 19th, 33.32 diagonal call spread for 90 cents. I know some people bought it less than 90 cents, but that's what the signal was, so that's what I'm going to use here, okay? Okay, everybody with me? Just so far, all I did was put up what the signal was and what we did. Okay, now let's talk about what is a diagonal spread. Okay, first, it is the combination of a calendar and a vertical spread. Okay. Now, we go through calendar spreads all the time, right? What are the benefits or what do we look for in a calendar spread? In a typical calendar spread, what do we look for? Whoop, that shouldn't be there. Why is that there? That's so weird. Sorry. Okay, implied volatility blip. Or what if there's not a difference in implied volatility? Okay, sometimes when we're not really looking at an earnings type play where volatility is different, where we are looking for a big blip or big arbitrage opportunity in volatility, sometimes we do calendar spreads like what we did with Match and what we did with Planet to take advantage of an upward move over time. Okay? So the way that I like to think about a calendar spread that is not done for the purpose of an earnings play is, and I'm going to put this on the board, is buying a further out option and financing it by selling a closer one. Okay, so in this instance, we're buying a July 19th option. We're financing it by selling the June 28th option. Does that make sense? Does that concept make sense? Okay. Everybody get that? Everybody understand that concept so far? That's kind of an easy way I like to think about calendar spreads. So we're buying something out in the future, financing it by selling something closer in. So that's the basic behind a calendar spread. Now, what is a vertical spread? Beautiful. Beautiful, Richard. Perfect. Gary, perfect. And Bill, perfect. That's exactly what I just put up. The combination of what you three just said is exactly, and David, what I just put up here. It's a directional trade using different strikes with the same expiration. You can have a vertical put spread if you're looking for a stock to move down. You can have a vertical call spread if you're looking for the stock to move up. Okay, so are we good right now with the concepts of calendar and a vertical? Okay, now, what if we want to combine the two? And we'll go into the rationale and the reasoning of why we would want to combine these two types of spreads, a calendar and a vertical. Okay, but if we combine them, what we basically come up with, okay, if we combine these two types of trades, then we have a calendar spread that uses different strikes. Okay, this is almost like a mathematical equation. Step 1 plus step 2 gets us to step 3. Okay, does this make sense? Okay, so that is the nuts and bolts of what a diagonal spread is. Now we have to get into why we would use a diagonal spread, but that is the nuts and bolts of what a diagonal spread is. Okay, so is everybody following along? Because I don't want to move on to the next step without everyone understanding this one. Okay, great. Now, I'm going to ask you guys, before I put anything up on the whiteboard, why the combination of these two types of trades to come up with a diagonal? Why do you think we would use a diagonal as opposed to just a calendar or just a vertical? Okay, Chris, definitely. Okay, Peter, yeah. I kind of, you guys are all on the right track. I kind of like Richard's answers so far best. We're looking for a little bit more direction or a little bit more delta, but also looking to collect theta. Or if you think about it, finance the purchase of our long delta. Does that kind of make sense? Okay. So we are still buying a further out option, but financing it with the sale of a shorter dated option. And because the strikes are different, this allows us added direction or delta. Does that make sense before I go to the board here? Okay, Pamela, what part of that doesn't make sense? Let's review it. What part of that does not make sense? Robert, we're going to get to that as soon as I go to the board because it'll be much better explained when we actually go back to the board in the option montage, and I can show you about expected move and all of that. Yes, the delta is different, Pamela, exactly. That's the reason we're doing this. Okay? That's the reason we're doing this. Okay? Now, what are we looking for here? If we're buying an option, in this case, a call option, that has a lower strike than the one that we are selling. Okay? If we're buying a lower strike call option than the one that we're selling, what sort of direction are we looking for? Another way to think about that would be, let's say this were just a vertical spread and not a calendar. Okay, let's use the strikes that we have. Okay, don't worry about the different expiration dates right now. Look at the strikes only, buying the 32 and selling the 33. What would we want to happen? Yes, it's a bull spread. We would want the stock to go up. Okay, so Pamela, you definitely understand that. So we're getting intentionally buying some long delta. Not a ton, but we're intentionally buying some long delta, looking for a move up. Okay, so does that help that part of your question, Pamela? Okay, great. Now, why the strikes we chose and why this type of spread rather than just using either a calendar or a vertical? Well, if we used a calendar spread, which would have been fine, we could have used the 32 or the 33. Yep, Pamela, I'm going to get to that. I want to, again, I'm trying to get through everything conceptually first, and then I'm going to go to all the charts here. Okay, so if we use just a calendar spread, it's going to be more delta neutral, right? If we use the same strikes, we're still buying a further out expiration option and financing it by selling a closer expiration option. However, the strikes being the same, there's not a big delta difference. See you, Peter. Okay, so we're still doing the same thing as in a calendar spread here. However, our strikes are different because we're trying to take advantage of a little extra direction, a little extra delta. We're definitely biased towards the upside here. Okay, so Adam, let's talk about this. Based on the conversations we've had this week, and there's been many of them about our match and our planet positions, which were just straight calendar spread positions, okay? How does theta factor into that? How does theta factor into that? Anybody? Perfect. Exactly right, Robert. The short option is going to lose its premium faster than our long option. Thus, the rationale, if you think about it, that the short option we're selling is financing the purchase of the long option that we bought. Okay. Now, let's take a look. Let's actually take a look at the breakdown of this position. Okay. Let me put the short 33 here, the long 34 here. So here is, okay, here's the order ticket. This is exactly what we did. Now I'm going to put this up on a risk chart here, but just from this here, we can see the delta being 19. Okay, because we're buying a lower strike call than we're selling. In a vertical spread, you get delta. In a vertical call spread, if you're long it, you get long delta or positive delta. In a vertical put spread, you get short delta if you're long the spread. Okay, so here you can see the delta of this spread was 19. Now, watch what would happen if we made this just a calendar spread where the strikes are the exact same. So what I did here was change the July option we're buying from the 32 to the 33, and you can see the delta almost got cut in half. The delta went down from 19 to 11. Okay, so Pamela, hopefully this helps you just to show now the difference between what a calendar spread would have been from a delta perspective to turning it into a vertical spread from a delta perspective. So we still have the calendar, but doing it this way gave us more delta, more upside exposure. Now, with more exposure to a trade, that also comes at a cost, right? That also comes at a cost. And if we look here, we can see that if we just did the straight calendar using the same exact strikes, we can see that that thing, however, we paid 90 cents, so an additional 30 cents to get the additional upside exposure because we're very bullish in AMD. Okay, now with any sort of calendar spread, okay, not when you're week to week, meaning, just 1 week apart, but any sort of calendar spread where there are weekly options and you have a difference of 3 or 4 weeks between your expirations like we do, you also have the flexibility or the opportunity to potentially roll the short option, meaning in our case, what's the best thing? What is the best thing that could happen to us with this position? Timing wise, stock price wise. Okay, so easy answer, right? Rob, you got it. Always wanted to move to our short strike, okay? Now, any move up is going to be good for us because we have long delta here. However, if we move up towards 33 by June 28th expiration, that is the best scenario for us because we will keep all of the premium that we sold in our short option, while our long option, because we have a nice long delta to it, will continue to increase in value. So that is the best thing that can happen. Okay, now to your point here, William, yeah, in a world where if our short option expired, went out worthless, okay, and if we kept the long option beyond June 28th, we would obviously want the stock to go up, 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 up. That's not the way we trade though, okay? I guarantee you we will not just be left with the July 32 call when the short option expires. One of two things is going to happen. If the trade has worked for us, which obviously is what we all want, if the trade has worked for us and the stock has gone up and the value of the spread has gone up, we'll probably just close the trade. However, if it's partially worked for us, or if technically the charts are still in a very bullish mode, maybe we buy back the short option for a penny or 2 pennies or 3 pennies, whatever it is, and sell another option to collect even more premium to finance the long option. That's one of the beautiful things about calendar spreads, and in this case a diagonal spread, is that it gives you the flexibility and the opportunity to roll your positions and sell more options. Okay, now, good questions. Why don't we always use a diagonal? Well, a lot of it comes down to the opportunity presented to us and our reward to risk opportunity. Sometimes a straight vertical, meaning using strikes within the same expiration, gives us appropriate reward to risk that we look for. And it's just easier using strikes within the same expiration. Sometimes a calendar spread will give us the appropriate reward to risk, and maybe that is the better option, no pun intended. The beautiful thing, though, about understanding and utilizing different strategies is that we take what the market is offering to us. We are always flexible as to the kind of trade that we want to use. Sometimes a calendar option is the best. Sometimes a vertical option is the best. Sometimes, like this, a diagonal is the best. And what does best mean? Well, best means from a reward to risk standpoint. What is the best opportunity for us out there? Okay. So that is what a diagonal spread is. And when you think about it, every option strategy that we use, okay, and some of them have fancy names, they sound intimidating. Oh my God, I can't trade an iron condor. I don't know what that is. Or what the heck is a butterfly or a broken wing butterfly, right? It can be intimidating. It can definitely be intimidating. However, when you think about it and you break down, like what we just did, what a spread really is, it actually becomes quite simple. The different kinds of spreads, the different combinations of possibilities out there are really still all just based on a long or short call and a long or short put. And it's how you put them together with other options to create the type of strategy you want. Absolutely, Jack. We'll do that right now. Mark, great question. Great question. Let's take a look at that. Okay, so we always want to give ourselves as much time as we can, right? We always want to give ourselves as much time as we can on a trade. Now, what do we have to give back when we buy time? If you buy time in a trade, it costs you more money. Okay? So there's always a balance there between buying more time and the trade costing you more. Okay? So why did I choose this? Well, I want to buy time to let this work for us. I want to buy as much upside time or time to let our upside call work for us because we're bullish. So I went out to July, okay, which is 4.5 weeks away, 5 weeks away, whatever it is. And if we look, the expected move going out to July expiration is what? Okay, you guys tell me. Anybody? Okay, good, Robert. Thank you. Anyone else? Okay, so we got it, right? Right around 380, 390. Great. So really we're thinking that if we just had that July option, that we would be targeting 34-ish, right? Now, what is the expected move out to our short option here? To the June 28th. What is the expected move going out to June 28th? Okay, yeah, right in that area, 230, 2.5, somewhere right in there. I totally agree with that. So if we look at where the stock is now, $30.20, see an expected move of about $2.50 out to June 28th, that puts us to almost $33, right? So if the stock does move in the direction and the upside, which we believe it's going to, the market is expecting that move to June 28th to be about $2.50, so an upside range of about $33. Well, you think there's something coincidental, the fact that that is our short option? Because again, what do we always want to happen to the stock? Okay, we always want it to the short. So that's our starting point. That's our starting point, is the short option there. Now, we work off of that. We work off of that. If the stock moves to 33, by the June 28th expiration, okay, look at that. Look at the reward to risk there. Okay, what kind of reward to risk, guys, do we typically look for in a calendar spread? Okay, what do we typically look for in a straight calendar spread? What sort of reward to risk? Perfect. No, John's got it. John's got it. Vertical spread, we look for about 3 to 1. Calendar spread, we look for about 1 to 1. Okay, if we look at 33 here, in fact, I'm going to put straight 33 in here as the price. Okay, our projection here shows about $1 profit. That's 1.25 to 1. Okay, now, not only is that 1.25 to 1, which is a really nice reward to risk, but as we spoke about earlier, what opportunity is still out there for us to potentially take advantage of? What opportunity is out there? Remember the flexibility. What is out there? Bingo, Gary, bingo. If we determine that we still want to keep in the trade, we can roll the short into another short option and collect more premium and keep the trade on and just keep collecting against our long option. Or listen, if we're at this point here, if this thing works out as planned here, we'll probably take it off. So that is what is behind a diagonal spread. Oh, Mick, if we were at 33, if we were at 33 on June 28th, is that what you're asking? What short would we roll to? Okay, so it all depends on a few things. Are we still really bullish about the position, right? Technically, fundamentally, is there still a reason at that point to be really bullish? If we are and we wanted to stay in the trade, we might even roll up to a strike, let's say the July 35, let's say, and give us then at that point a really bullish vertical spread. Or maybe we roll out just 1 week to July 5th options and sell a 33, a 34, something in there. Okay, Todd, that's a great question. Okay, and like I said before, there's a mix when you look at a diagonal. There's a mix of the combination of a calendar and of getting extra delta, and it all comes down to, with any signal, what is the most opportune reward to risk? Sometimes a diagonal like this, if we're a little bit more directionally inclined, sometimes that's a better opportunity. Sometimes just a straight calendar. Robert, everybody filled AMD, and you can still get in it right now if you wanted to. Everybody, I just don't have it up on the board yet. I haven't had time. Sometimes a calendar spread, which is a little bit safer meaning costs less, doesn't have as much delta bias to it. Sometimes that is the better opportunity based on the reward to risk, and sometimes just a straight vertical spread, where a lot of you answered when I had asked what kind of reward to risk do we look for on a calendar. Some of you answered 3 to 1. That's what we really look for on a vertical spread. So if that opportunity is there, then we go with that. Good question here, Todd. The thing with Uber, we could have looked at a diagonal, but the reason that we looked at the straight vertical spread was because the reward to risk was right in our sweet spot. We were looking at a $3 wide call spread to pay 75 cents, put us right at 3 to 1 reward to risk. I never want to overcomplicate things, right? I want to take the easiest trade setup that offers us the proper or best reward to risk. No need to overcomplicate things. Make sense? All right. I am glad that we had this discussion on diagonals. I will post it up in the room. Everybody who wanted to, in fact, I'm going to put this up here right now. Everybody who wanted to should be filled in AMD, most at better prices than 90 cents. Okay, it's up there. No, Michael, tandem, if you didn't get in it, would not be a valid entry at this point. If we're already in it, we're still in it. If you haven't gotten into it yet, you don't want to be in it. Okay. Todd, I'm still looking for the same as what we did yesterday, but the stock has to come down bit. Okay. Why is that being devil's advocate, Robert? We're not. We hope it doesn't go down to 29. The trigger point was like $30 in this trade, so we want to get in right around there. Yeah, Todd, it didn't fill because we were trying to buy a little bit lower than where the stock was trading. And so for our option price to trade at 75 cents, the stock would have had to come down a little bit, making the value of the trade a little bit less. Trade, I think, was trading about 80 cents yesterday when we put our signal out there. Okay, we were trying to buy the July 45.48 call spread. Whoop, let me go back to Uber here. Okay, we were trying to buy this call spread for 75 cents. It's now trading almost a buck. When we were trying to buy it yesterday, the stock was trading down below 43. It was trading like 42.75, 42.80, something like that. It wasn't quite trading down to our level of 75 cents. Okay, the market may have been, 70-cent bid offered at 85 or something. I don't remember exactly what it was, but it wasn't trading at our bid price of 75 cents. That did not trade yesterday. Okay, so if Uber does come back down like another dollar or so to where it was trading yesterday when we tried to buy this spread, we'll reevaluate, and if we still like it, we'll revalidate. All right. All right, everybody, let me take a little bit of a break. Let me get the video posted up in the room, the whiteboard, and I will be back in a little bit.